Welcome to Excel and Finance video number 8. Hey, if you want to download this workbook and follow along, click on the link directly below this video. If you're in the class, just go to our class website. Hey, these videos, I'm going to shoot them full screen. Usually I make them kind of small. So you definitely, if you're watching this, want to hit the full screen button. Hey, Chapter 2. Chapter 1, we talked about introductory terms, the goal of finance, and things like that. In this chapter, we're going to talk about financial statements, different aspects of the balance sheet and the income statement, but all in terms of what finance people do with the numbers, not accounting people. So accounting people see the numbers on the balance sheet and the income statement and use the numbers differently than finance people. And we're in particular, the last couple of videos we'll talk about calculating cash flows from financial statements. Accountants do accrual accounting, which is does not necessarily reflect cash flow. So we, as finance people, need to calculate cash flow from financial statements. And we'll talk about the difference between average and marginal tax rates. All right, first we'll take a look at the balance sheet. I'm going to click on this tab right here. Balance sheet. Last video we talked about assets equal liabilities plus equity. That is the fundamental accounting equation. Not just accounting, finance. Everyone dealing with businesses and numbers uses this equation here. The balance sheet just reflects this. Assets on one side equals, and then there's two other things on the other side, some liabilities and some equity. Now, I have in this sheet here, if you point to these little red comments, they have notes. Last chapter and in chapters coming up, I'm going to have lots of PDFs. In this chapter, I just don't really have. I have one PDF that shows a deductive proof for one of the formulas we're going to use. But otherwise, all the notes are in this workbook. Now, this is a note for those of you who have done accounting. And actually, you can right-click that and say Show Hide, and then it will show. In this class, we will not prepare financial statements. We will use them as a source of information. Actually, that's not quite true. We're going to do really, really basic financial statements with condensed numbers that finance people would use. The financial statements we see in this textbook will be condensed, and we'll ignore such things as proper titles, showing the proper expenses. You know, when we have interest and tax, it should be interest expense, tax expense. We'll list them lots of ways. But if you see interest paid and tax paid, usually in accounting, you don't want to list expenses like that. But in finance, we can go ahead and list things like that. If you want to move the comment, you can point to the edge and just click and drag. If you want to hide it, you can right-click Hide Comment. Now, assets. Current assets. These are assets like cash. Accounts receivable. Oops, what's accounts receivable? Accounts receivable is something that'll be cash soon. This is when Home Depot gives the lumber to the contractor, and the contractor pays him 30 days later. So when you see accounts receivable, $465 or millions as it may be here. It looks like my screen is not, there we go, in millions. That means that number of dollars is owed to Home Depot. So accounts receivable is like a holding tank until we get the cash from the customers we've extended credit. So cash, accounts receivable, inventory. These are all called or classified as current assets because these can be converted into cash in a year or less, or the normal operating cycle. Now think about this. Accounts receivable, hopefully we're going to collect it within the next 30 days or 60 days or whatever it is. Inventory, the whole point of having inventory in your store is so you could sell it and get cash. So current assets. Now this is very important, not only in finance, but accounting and auditing and all sorts of banking. It's very important to see a business's current assets, because if they don't have very many current assets, perhaps they can't pay their bills. In addition, we will talk about the other side of the equation, liabilities. Current liabilities. Well, if this is collect cash in a year or less. This is pay cash in a year or less, and that's current liabilities. Current liabilities are the bills that we have to pay within 1 year or less, or the normal operating period. So this is cash out. This accounts receivable, current assets are cash in for all sorts of people: accountants, bankers, financiers, internal managers. They always need to know current assets, current liabilities. Because if this is the cash out, this is the cash in. If cash out starts to get bigger in the short term than cash in, then you need to do something. You're either in trouble, or you need to do some financing, like going out and getting a loan, or trying to collect accounts receivable more quickly, something like that. All right, and then on the asset side, we have fixed assets or long-term assets. These are your building, your trucks, your patents, the long-term assets that actually define your business and are the assets that you've invested in because you think you can make a profit from them. So UPS has a lot of brown trucks because they're in the delivery business. A manufacturing firm maybe has a lot of buildings and has a lot of equipment to manufacture whatever it is they're manufacturing. Fixed assets, long term. Now we're going to see net fixed assets. That means whatever the original historical cost of your asset, your machine, your truck, minus the depreciation. And we'll talk about depreciation in just a bit. And then we have total assets. Now, many financial statements showed multiple periods. And the reason why is because you want to see what is the change, right? Cash was this, cash went up. Accounts receivable was this, it went up. All right, so you want to see the difference. And in this class, we are going to, in this chapter, next chapter, we'll be calculating the difference. Now, let me ask you a question. Balance sheet is, it says up here, snapshot of the account balances on the last day of the period. So really, if this is 2007 and our ending year is December 31st, this balance right here is December 31st, 2007. Now, what about this one? This is December 31st, 2006. So what's the difference between the two? Well, it's the ending amount from 2007. We take that and we subtract from it the very beginning amount in the beginning of 2007. Well, the beginning of 2007 is always whatever the balance was on the last day of the last year. And for example, in Chapter 2, we probably do this calculation end minus begin 50 times in the homework. Some homework problems literally have you do it 20 times because we're going to be analyzing the balance sheet, and we need to know the change. Right? An example of a change that might not be so good. Imagine if accounts receivable went up, ballooned massively, much more than your sales. That could mean something like you're not collecting your accounts receivable, and that could lead to trouble. All right, assets, current asset, fixed assets, and then total. Liabilities and equity. These are the assets we buy. This is the source of funds. We either go out and get debt, current liabilities, or long-term debt, or we issue equity to get our funds, which means our cash we're going to use to buy our assets. So let's look here. Accounts payable, notes payable, short term, right? This is when we go out and we owe people for some products or something like that. This is when you actually go out and borrow money. But you have long-term debt, short-term debt. On the balance sheet, you got to break it apart. Whatever current part must be listed in the current liabilities, which means it's owed within 1 year or less. Long-term, both of these are debt. I mean, all of this is debt. All right, and then we have equity. The common stock, sometimes you'll just see equity in when we have our little mini balance sheets in this class. But other times you'll see common stock and paid in surplus. All that means is common stock. If the original stock was supposed to be priced at $10 and it got sold for $12, the paid in surplus is the $2 above the $10 it was supposed to sell for. But that's the amount that stockholders paid to become owners. And then retained earnings. That's the net income from the income statement over the years that is accumulated, right? So you can do two things every time, and we'll do this in this chapter. Every time you make some profit, you can either pay it out as dividends or plow it back in to the company, keep it in the equity section, and then it's available to, for whatever assets you want to invest in. All right, so then we add it all up. Total liabilities plus the total equity equals liability plus owner's equity. Now, why is it called the balance sheet here? Oh, because there's an equal sign right there. This has to equal this. So we go like this, right? Equals, and I'm going to do 2007, that one, tab, equals this. And I'm going to say, is this equal sign, is that cell equal to this cell, tab, true. All right, so that's why it's the balance sheet. All right, working capital. We were talking about current assets and current liabilities. Let's go up and talk about current working capital. Oh, right. We mentioned this earlier, right? If current liabilities are getting too big or even much bigger than current assets, you're kind of in trouble, right? Because if this is current assets, right? Things like cash, inventory, accounts receivable, it means cash coming in. This is all the short-term debts, meaning cash going out. Well, if cash going out is much greater than the cash coming in, you're in trouble. And so net working capital is the term pretty much everyone uses, accountants and financiers, that for the difference between these two. And in this chapter, we will calculate it when we do our cash flow calculations. And in the next chapter, when we do financial statement analysis, it'll be an important ratio and measure. Net working capital is the short-term capital, cash that the firm has to work with. It's not always cash, but it's as if, right? Because all of this is supposedly going to be converted to cash within 1 year, and this also. Capital is a term that means assets. This term is often used in economics and finance. So in accounting, you'll see net working capital, but in finance, you'll see capital referring to the assets all the time. In accounting, you see assets, but the one exception is net working capital. All right, so let's here in this cell. Now, I'm on this sheet working capital, and my balance sheet is back over here. And I want to calculate our net working capital here for at the end of 2006. So I'm going to do a formula, and we're going to do sheet references. Now, equal sign is the symbol you put in to say, hey, Excel, I'm going to do a calculation. And to get some numbers on a different sheet, you just got to type the equal sign and then click on that sheet. Right, here is the 2006. And again, balance sheet is always the last day of whatever period. This one's a year, by the way. It could be month, or even some companies have everything automated and they do it by the day. Nevertheless, current assets minus current liabilities, right? So I'm going to come down here. Let's see. Oh, total. This is 2006 current assets total. Now look up here, you can see the formula. Equals, and then balance sheet. That explanation point means this is on a different sheet, and then B13. I'm going to type a minus and watch what happens. Right there, you can see that minus. And then I'm going to click current liability total for 2006. Now notice, up in the formula bar here, we can see our formula. It's really just two cell references, but they happen to be on the sheet called balance sheet. Now, those little apostrophes usually come around because if you have spaces, it doesn't like spaces, so it puts that single apostrophe. But that explanation point is what tells the formula this is a sheet name. All right, now, as soon as you get it done, do not click back on the sheet. You can see this one, we're building it here, but that one's white because that's where the formula is being created. Do not click back because it will ruin your formula. What you do is you hit Enter. Now I'm going to click right here, and I'm going to hit the F2 key. There it is. There's our formula. OK, so that's pretty good. Now, net working capital is all over the place. Different businesses, different industries have different numbers that are good or bad. But in general, you want it positive. Now, let's go over to a different sheet. I'm going to jump to the sheet. Where is it? I can't see it. I'm using my little arrows over here to see where it. Oh, there it is. It's right there. liquidity. I want to come over to liquidity. Liquidity is how quickly an asset can be converted to cash. All right, now liquidity is important, just like working capital is important, because if you run out of cash, you're in trouble. The number one reason that businesses big and small, not just mom and pop stores, people that run small businesses know, but all the way up to gigantic banks, as we saw in the financial crisis, people ran out of cash. So liquidity is very important. If your working capital, right, is getting too small, maybe you have to sell assets so you can get cash. And in fact, that's what happened during the financial crisis. People tried to sell assets, but during a financial crisis, hard to sell assets unless you're going to give a really low price. So let's talk about liquidity. Liquidity, how quickly an asset can be converted to cash. Just straight simple. How liquid is cash? It's the most liquid. How about inventory or accounts receivable? Those are pretty liquid. If you're not in a financial crisis, you could sell those in emergency. In fact, you could sell accounts receivable to banks, for example, right? So those are examples of assets that can quickly be converted to cash. What about a building? What about your truck? What about your machines in the shop? Well, you probably don't want to sell those, right? Those are examples of assets that are less liquid. All right, liquidity has two dimensions. Ease of conversion to cash. Again, cash, accounts receivable, easy. Your machines in your shop or your buildings are less easy to convert to cash. The other aspect of liquidity is loss of value because you have to sell it quickly. Because you can pretty much, except for in a financial crisis, you can pretty much sell anything quickly if you reduce the price enough, right? So the building, it is hard to sell, real estate sometimes. It's hard to sell a machine quickly. But if you lowered the price enough, a fire sale in essence, you probably could sell it. So liquidity has two dimensions. When you're measuring liquidity, you want to be able to not only convert it to cash quickly, but not lose a lot of value. Another aspect, we mentioned selling assets. Another aspect of liquidity is businesses that can go out and get a loan quickly have access to liquidity because they can get cash quickly, not just an asset sometimes. Okay, highly liquid assets, quickly sold without significant loss. Inventory, short-term investments, right? So a lot of times you'll see people invest in short-term bonds or something like that. Illiquid assets cannot be sold quickly without significant price reduction. Machine, building. But what about the financial crisis? What happened in the financial crisis? Everyone had more debt, too much debt. In specific, it was mortgage debt. Even more specifically, it was things called collateralized debt obligations, which was just a lot of mortgage debt. And when the financial crisis hit and everyone knew that the housing prices were going down and the debt on those houses was no good, they couldn't sell it. Before the financial crisis, they had liquid assets. They could go out in the financial markets and sell them. But during the financial crisis, forget it. It was as if everything froze up. Everything was illiquid. Items on the balance sheet are listed in order of decreasing liquidity. So if you go back and we look at our balance sheet, right? Oh, that's why cash is first and fixed assets are last. Liquidity. Liquidity is valuable. Firms can readily pay bills and buy assets quickly. So we mentioned this one earlier, you got to have enough cash or working capital to pay your bills, right? But there's another aspect. If you look around sometimes, Microsoft over the years before and other big companies, sometimes you see that they have a lot of cash. And you're thinking, why do they have all that cash in the bank? Because cash in the bank doesn't earn a very big return, right? If you have a lot of cash, you should go buy whatever assets. UPS is buying trucks. Google is buying up buildings to put server computers in. So if someone has a lot of cash, it could be that they're saving up to buy assets quickly or take over companies. Like Microsoft always had a lot of cash because if they wanted to buy a company. So liquidity is valuable because you can pay your bills and buy assets quickly. Liquidity assets such as cash tend to be less profitable than illiquid assets such as building, trucks, subdivisions of business. As we just mentioned, right? You probably don't want to have too much cash because you can't earn as much as if you invest in profitable assets. Now, sometimes it's, like right now, this is 2010. Between the financial crisis 2007 to 10, businesses have tons of cash because they're not quite sure what to invest in, and they're nervous because during the crisis, liquidity dried up and they didn't have anything, so they're saving lots of extra cash just in case things get in trouble. All right, let's do a little bit of. I'm going to go over to the sheet called Building a Balance Sheet. In this chapter, we're going to have lots of homework. And let's see how to do this. We're going to be given little small problems. These are not real balance sheets, but they're, in essence, summarized, reduced balance sheet. We're going to be given things like current assets, fixed assets, current liabilities, and long-term debt. Notice they don't give us anything about equity. In this class, throughout the whole textbook, we're always going to have to back in to numbers. All right, so total assets. Well, if we have our 250, I've already built this. These formulas are looking up to these assumptions here. So I have current assets and fixed assets. So we'll do that. In the homework, this will come. I'm going to give you templates, and then you type these in, and then you build all formulas here. Total assets, I'm going to say equals SUM, and then highlight these two cells right there. Now this is. You can see right here the equal sign. It looks like the equal sign's in that cell, but when you click there, there's nothing. So I'm going to click on this column and drag it to make it a little bit wider. Now, total liabilities, again, I did the same thing. Looking up there, I'm going to Alt equals, that's the keyboard shortcut for AutoSum, and enter. But how in the world are we going to calculate equity? Well, let's see. Oh, guess what? The fundamental accounting equation. If this is all the liabilities and this is all the assets, remember the definition of equity is assets minus the total debt. So this is an example of backing in. And some of the backing into answers in this for homework in this class will actually be quite tricky. We'll have some examples of that coming up. Oh, so there we go. Enter. 480. So now I'm going to equals SUM because I want to add this up and triple check. Right, and then, oops, notice I have a minus there. That'll give me a minus sign. I meant to type an equal sign. All right, now working capital, always going to be current assets minus current liabilities. Now this is the working capital at this particular moment in time, because balance sheets are always one day, a particular moment in time. It is a camera taking a picture of all the accounts. All right, current assets minus current liabilities. Oh, look at that. They have a positive working capital. All right, let's go over to debt and equity. We're still talking about the balance sheet. In finance, we have assets. Oh, that's the use of the funds. On the other side of the equation, I'm going to jump over. We have debt and equity. Source of funds. Now, what's the difference? This is a fixed claim. Contract. It's a contractual claim. You must pay the full amount back at some point in the future, and interest. It's a contract. This is a residual claim. Guess what? When you go out and invest in the stock market, if the company does the company have to pay you back by contract the full amount? So you bought a stock for $10. Does it have to pay you back? No way. If it goes bankrupt and there's not enough money to even pay off the creditors, you get nothing. So residual means left over. Not only that, but dividends. Just here's contract, right? It says you must pay interest, 5% interest, right? You must pay it. It's a contract. You don't get paid, you go to court. Or you go into bankruptcy. But this, forget it. Dividends are only paid when there's something left over. Now, what is the upside? Why would people ever do equity if it's always residual? Because if it's a good idea, think about the early investors in Microsoft. If it's a good idea, you can make a lot of money, right? Interest expense is a cash out, and it is tax deductible. Wow. We're going to see an example of that just coming up here. But because it's tax deductible, when you pay interest, there's cash interest. Let's just say $25 going out. Because you get to put it on your tax return and subtract it, it means you will avoid paying some taxes. Avoid if you hadn't incurred debt. So when you pay out 25 bucks, actually you get a little benefit on your tax. So it's not a total 25 bucks. Maybe it's like 23 net that you will get. And we will see an example of that. Tax deductible, huge advantage to debt. That is why over the last quarter century, companies have loaded up on debt a lot because there's a benefit. Dividends cash out is not tax deductible. And we'll see an example. We'll compare buying a new machine and using debt and equity, and we'll see that there is a small advantage of using debt. Debt also is paid off first during bankruptcy. You get whatever's left over. All right, let's go to this next sheet here. Debt. I just want to point out the topic of whether to use debt or equity to raise funds is called capital structure. The term financial leverage is used when the firm has debt. So leverage, it just means like a big leverage thing. You can actually, if you're using debt wisely, it can you have that advantage of a tax deductible advantage, and we'll see an example of that later. But leverage is the word they use. Next chapter, in chapter 3, when we do financial ratios, we'll have ratios that will tell us how much leverage we're using. The more debt as a percentage of assets, the more leverage. And leverage can magnify gains and losses. More later on that. Market value versus book value. I think this is our last topic in this video about the balance sheet. And then next video we'll do income statement. Market value, that's the amount of cash we would get if you sold it. Now, market value, you hear a lot about this. Market value for financial assets like stocks and debt sometimes, right? You actually can go out and see what the market value is every day. But most assets, all the machines and the trucks and the buildings, all sorts of other assets don't really have a market where you can go and see what the actual price is if you sell it, right? So market value can be slippery sometimes. People make estimates, but it's only for assets or debt that have markets where we can go see a price that market value is easy to get. Otherwise, forget it. You do not know for sure until you sell it. You never know for sure until you sell it. Book value. This is what accountants have been doing for a long time because how in the world are you going to get market value? So accountants say, forget it. Book value is more reliable. When I buy the thing, the business, the inventory, the building, whatever it is, that receipt told me how much it is, and that's when I'm going to record it. This is called the historical cost principle. Required by GAAP, generally accepted accounting principles. Except some financial assets are recorded as market value. And actually, there's a huge debate. Right before the financial crisis, the FASB and other regulations for accounting said that businesses had to record many financial assets, particularly in banks, had to record financial assets, debt, and assets at market value. But what happened during the financial crisis is that many of their assets they couldn't sell anywhere, and they had no idea what the price was. They had to write it down, and they had to do a lot of guessing. So market value actually, although it's a pretty good idea, it's being heavily debated because if we have bubbles like our housing bubble or the dot-com bubble in the 90s, then there's a problem with recording things at market value. Actually, the FASB, the accounting, generally accepted accounting principles before the crisis said banks had to record things at market value, and actually it was suspended, and now it's being debated whether it's a good idea or not. But in general, at least through the history of accounting, accountants have recorded things at historical cost. Book value of assets often doesn't reflect the firm's most valuable assets, such as talented employees and managers. Right, more and more employees are really what can make a particular entity worth whatever it's worth. But there's no asset called employees. Customer lists, reputation. Not only that, but the actual, all the things that they buy can change radically. The actual tangible, these are all like intangible assets, but tangible assets also can change a lot also. That's why if you look at publicly traded companies, their market value, if you look and see all the stocks, whatever it's worth in the stock market, can be radically different than what's on their balance sheet. Stockholders' equity. Market value for share of stock is virtually always different than the book value. We just said that. Since the goal of financial management is to maximize the market value of the stock, and again, we talked about the problems with that, but again, in theory, that's a good value. If that's the goal, thus the financial manager is interested in market value, not book value. And sometimes, for a financial manager, you can go out and look at the stock market and see what the value of that stock is, and you know how many there are, so you can actually very easily calculate market value and compare it to the book value, which book value just means the total asset value on your balance sheet. All right, let's try a little example here. We have a few homework problems where we're going to do this. We will just be given the numbers. We're not going to have to go out and do research on it. Fixed assets book value. Fixed assets appraised market value. Now that says appraised, but again, if it's a publicly traded company, you can easily get the stock value at any particular moment and then the number of shares outstanding and calculate that. Net working capital book value, that's on our books. Net working capital market value, that could be pretty slippery, but perhaps inventory increased in value or went down. In this example, it went up. Long-term debt. We want to calculate what is the book value of equity. What is the market value of equity? Well, here's our book. Net working capital. Right there. And the market equals this 800. Enter. Net fixed assets, the book value right there. Tab. And then this one right here. All right, now we have book and market. Now I'm going to highlight these two cells and use the keyboard shortcut Alt equals. Alt equals is auto sum. Notice it did both of them at once. If you don't believe it, hit the F2 key and you can see sure enough it got it right. All right, now let's come over here. They gave us debt. We're going to have to back into our equity again. The debt, I'm going to go right there. Tab. We're going to assume that the debt didn't change, so I'm going to say that one right there. And well, now what do we do? What's the stockholders' equity? Oh, well, we can back into this again, right? Just like we did in our last example. There's total assets. Actually, I better put total assets. I probably could have put just TA there. We'll use that a lot next chapter, total assets. Well, right here, if this is total assets, boom, and there's our debt. The definition of equity is, residual, so equals this. Now watch this. I'm going to do this as a formula minus this. Now, really, for some of us in this class, we're brand new to Excel. This is a relative cell reference, as we mentioned in chapter 00. This formula is really saying, hey, go 1, 2, 3, 4 to my left, and then 1 down. Okay? And this one's saying, hey, look, 1 above. I'm going to control enter. That puts the formula in the cell and keeps it highlighted. And watch this. I can just copy this over. Why? When I click here and hit F2, because this is still 1, 2, 3, 4 to my left and 1 below. And this is still looking 1 above. And now we can check this. Alt equals. OK, so that's just a little example of market value and book value. All right, next video, we'll talk about the income statement and things like depreciation and accrual accounting. And then move our way towards cash flows for finance calculations from financial statements. All right, see you next video.